Welcome to Wealth Management Mixtape, a go-anywhere show about life, finance, and investing. Join Jake Heisler and Tim Miller as they talk about what they're reading, writing, and experiencing. Jake Heisler and Tim Miller work for Quaker Wealth Management. All opinions expressed by Jake and Tim or any podcast guests are solely their own opinions and do not reflect the opinion of Quaker Wealth Management. This podcast is for informational purposes only and should not be relied upon for investment or financial planning decisions. Clients of Quaker Wealth Management may maintain positions in the securities discussed in this podcast.
Well, we had a big week this week, right? Had the Fed meeting and Jerome Powell. By the way, his press conferences are so boring. It's just, he's reading from that script and it's just like monotone. I think I talk like in a pretty monotone way, but Jerome Powell has me beat.
Yeah, so dry.
It can't. He can't say anything with any inflection or like the market interprets it immediately. He's got to pick his words right, the correct words. Even his answers, like where some of them were, he already had a written answer. Some of the questions that were asked, he had a written answer already. And man, it's just monotone and boring.
Has to be the worst job. You're just like, it's kind of like a referee. No one really gives you credit when things go right. They only blame you when things go wrong, right?
That's a good analogy. Yeah, that's pretty good. Anyway, the Fed increased rates by the consensus, which was 0.75%. So that's a pretty big raise, same as last month. So the target rate now is between 2.25% and 2.5%. That's pretty quick from where we started at the beginning of the year. And the market responded pretty well, right? Which it did last time also. So if you remember last time, Fed increased rates, also 0.75%. Market rallied that day. But the next day, the market dropped by 3.5% or 4% or something like that in one day. And today, hold on. Let's get a confirmation of this. And I'll use my phone. Let's see what the market's doing
Still
right
have
now.
what, 9 minutes left in the trading day?
I don't want to speak out of turn here. No, we're good. Market's up 1%. 1.25% on the S&P. So we got a follow through day, and it actually started low on the day. It started negative, and then it turned positive. So I made an observation that it seems like the tide's starting to turn on how investors are interpreting news. And we'll put this little graphic up. I made this thing that relates the news cycle and market interpretation. And it starts off that good news is good, and then good news is just okay, and then okay news becomes bad. It's like as the market's dipping down, right? And then bad news becomes awful, and then worse news, which is what we just got, I think, which was inflation is in June was the highest in a really long time, 40 years. And then the Fed's aggressively increasing rates to counterbalance that. And what we'll talk about in a second is GDP was negative again for the second quarter in a row, which for all intents and purposes could be a recession. What's the worst news is all of a sudden okay, right? So I think that's maybe the market's a discounting tool. So maybe it's interpreting this as can't get any worse than where we are now. So some buyers have kind of stepped back in. What do you think?
Yeah, I think the worst news is kind of showing like the inflation number was terrible, but they're saying maybe inflation has peaked, right? So it can't get any worse to your point. Or we've had 2 negative quarters of GDP growth, but this isn't a typical, these aren't typical signs of a normal recession where we still have a tight labor market. Jobless claims are relatively low compared to other recessions. And the economic data hasn't broken down to a point that we've seen, during other recessions. So it's kind of funny watching like the Federal Reserve and the White House come out and say, try to plead their case for why we're not in a recession, although technically, by definition, we are. but everybody's going to have their own interpretation of, are we in one, are we not in one? And now do we have the ability for a soft landing, which is, we would think unemployment would have to tick up from here in order to get inflation down to that 2% target. But, are they able to do it in a way that keeps us out from an actual recession, which we would think means heightened levels of unemployment?
Right. And I'm going to push back. That 2 quarters of negative GDP isn't a recession. It just so happens that every time that's happened in the past, it's been in the middle of a recession. So I don't know if that's the cause of it, but that's part of the ingredients, right? And so we talked about last time, the National Economic Bureau or whatever makes the call in arrears and says, this is when it started, this is when it ended. And usually negative GDP is part of that. But if you look at GDP, again, if you kind of look under the hood, a big component of the negative GDP this quarter was inventories. So, that was minus 2% on the number. And that number, at least initially reported, was minus 0.9. So if you take that out of the equation, I know you can't, but if you take that out of the equation, it's still in a positive growth territory. And I'm not trying to, maybe this is a harbinger of things to come. I don't know, but you never know. But it's not. Maybe that's part of it. People weren't seeing, awful across the board in this report.
Yeah, I feel like there's been just certain parts of the equation of what kind of makes up GDP as a whole that have been a drag to drag GDP in obviously down in the last couple of quarters. But I think in the last quarter, if I remember correctly, it was like the trade deficit, right? So you had like the supply chain issues and all the ships were kind of lodged off or not able to come in. And then they all came in at the start of 2022. And that really was a hit to GDP. So supply chain issues are kind of factoring into those GDP numbers. And now you have maybe slowing down, CapEx spending. I think it was capital spending, and government spending was down. But, just certain things I think are the timeline in which they're playing out with different things happening as far as supply chain or, the war in Ukraine, which is exaggerating some of these issues that already, were present before, the war and other things were kind of in place. But
it's just, everything's all out of whack. Everything's all out of whack, right? We've got negative GDP, we've got full employment for all intents and purposes. There are layoffs happening, but they're not across the board, right? There is talk on corporate earnings reports about, the word inflation and recession's been brought up quite a bit. You'd think that would lead to additional layoffs, and we talked about this in the past, but usually in a recessionary period, the unemployment at least doubles, right? Which have to mean we go to 7.2% or something like that. So do you think we get there? So let's say inflation, let's just track this through, right? Let's say inflation gets better, right? It's not as bad in July. In August, it's not as bad in September. The Fed, therefore, doesn't have to continue being so hawkish and raising rates as quickly. Treasury yields come down a little bit, right? That means theoretically high growth names would benefit that have already pretty much made layoffs, right? What do you think? How would that unravel?
I think everything just points in the direction, at least from my standpoint, and I'm not an expert on the economy, but I think there's a real opportunity for a soft landing where I don't believe that we're going to double unemployment. Like I think we were talking about it earlier, that unemployment is lower now than it was at the beginning of the year. So for us to double unemployment from here, you would think that it would tick up a little bit, but to double, I think that's a big jump from where we are now.
I hope it doesn't. One of the mandates of the Fed is to keep unemployment relatively low. So they can't go too far. We're where we were, I think, in 2019, right? If I remember correctly, the Fed funds rate. This is when they started cutting.
Yeah, I think you're right.
So they've gotten back there. I always thought, well, this is obviously increasing interest rates is meant to curtail demand, so spending goes down, which impacts earnings, right? At the corporate levels, they cut costs usually through labor to keep their bottom line looking good. But it just feels to me that, again, everything's so out of whack. I wouldn't be shocked if it stays relatively low. There's probably an uptick somewhere in here. But that earnings get screwed up because the dollar is so strong. So if you do any international business right now, your earnings look awful. If anyone's paying in any other currency besides dollars. If you're manufacturing in the United States, it'd be positive, but a lot of these big tech companies don't, right? So they probably have negative numbers. So they have to cut. I would imagine companies that have a pretty robust international presence or customers would have problems through this. So I was wondering, well, is this like just going to be an earnings recession? Like, did we just have bad earnings for a period of time that get revised down and then ultimately come and get revised back up again without as much unemployment? Because if the dollar comes down, right? We're getting I'm going off on a tangent here, sorry. But the dollar goes down, I'm just thinking this through, by the way, as I speak. Dollar goes down, that same revenue becomes more, affects their bottom line in a positive way. And they don't have to cut labor cost as much. So this is all screwed up from COVID. Everything's screwed up. So I don't think we go back to normal, like where one thing causes the other, for a few years. So I wouldn't be surprised if we have like a soft landing and everyone wants there to be a recession because everyone said there's a recession, going to be a recession. And so if you peruse Twitter, you got a lot of people mad because no one's calling this a recession yet, officially.
Do you think that part of when you talk about earnings, maybe it's just going to be an earnings recession? Do you think that some of these companies are giving some slack or some leeway with their earnings just because, by definition, we're technically in a recession and people kind of already price this into their earnings calls that we're going to have worse earnings than were initially thought, and there's going to be, a lot of these earnings calls will have the same kind of repetitive. This is why we did this, and this led to this. And a lot of it is inflation is something you hear every single call, or we had to cut spending here. But a lot of these companies are saying the same thing. They think that for social media stocks, ad revenue is gonna go way down, right? And every one social media, Facebook comes out, or Meta, whatever it's called now, comes out and says that ad spend is gonna be soft, and then it touches 10 stocks because everybody's reacting to the news of one company. But some of that, I believe, is already priced into certain sectors of the market. And therefore, we might have some positive surprises when some companies actually report because everybody's expecting their earnings to be so bad as is. Right.
That goes back to that curve, which is can it get any worse? I mean, I don't know. You're right. I mean, that's the job that the market is supposed to do. It's not perfect, but is to discount in those future prices or future earnings. And so I don't know. Maybe it's so bad now that it's good, meaning it can't get any worse, and then things come back again. I just wonder. I look backwards at all the recessionary periods, and if we are truly in a recession, and the bear market that was associated with it, and then how often you kind of tested the bottom of the market. And usually there's two obvious tests of the low, and we haven't gotten there yet. So I wonder if there's this. We haven't unraveled all the bad news just yet, right? It's not all priced in, but a good chunk of it feels like it certainly is.
I think the market reaction today shows you that maybe not all the bad news is priced in, but the one thing that the market's most concerned about and has been for a long time now is inflation. And it shows in that kind of follow through today of positive market performance.
Yeah. It's wild. That's for sure. We always say that these market downturns are normal. They happen all the time if you look back at history. But the ingredients that go into it aren't always the same. And so I think the human psychology, the reaction to it's the same. But the ingredients that cause that reaction are usually different, and it's always a challenge to get through that. I think that's part of why people struggle with it, with staying invested, and we're going to talk about that in a little bit. But it's because there's different things being factored in, and so you say, "Oh man, I don't remember the last time we had X happen, or whatever it is," and so it feels new and different and scarier as a result. And so we'll see. It'll all play out. Eventually, the last sellers will sell if they haven't already, and then the buyers will take over. And when buyers take over, the market rallies, and that's when you get the recovery period.
Why don't we jump right into our planning practice topic, just because we're kind of already on the subject, which is, I'll let you lead into it, which is talking to your clients about the market.
Well, I think if financial advisors have look, if the market's going up 3 out of every 4 years, right, and that average up year is higher than the average down year, because oftentimes advisors are measured by markets, by performance, they've got it easy for a few years. And then that 4th year hits this year, right? We just happen to have this and COVID in the last couple of years. And this is really where advisors earn their fee. Now, I would argue that the value add from a financial advisor should be pretty extensive at this point in time, with planning from a tax standpoint, estate standpoint, insurance standpoint, coordination of financial professionals, et cetera. But if oftentimes it comes back to being judged by market performance. And so I think this is really when you kind of separate yourself from other financial advisors, and how you have these conversations with clients matter. I use an example that's this kind of like this pothole example that clients get worried. Not everyone, but a lot of people do, and they're kind of walking towards this pothole of bad decisions, right? And part of our job is just to intervene, to get in between, and not let them fall down that hole. Because we know over time staying invested is the right decision. Let us, as a firm, as investment advisors as well, make those strategic decisions out of a portfolio. But let us also help you not make a detrimental decision that sets you back. And the example that I've used in a previous article is, if you missed, oh man, I forget the number. I think I mentioned this in the last episode too, but it's either like the 10 or 20 best days in the financial crisis recovery. It would have put your recovery back a full year, right? That's so meaningful when it comes to your goals, and most people's retirement. So it's just, I think this is the time to have conversations. We'll run through in a second, kind of what we think are kind of good steps to take as an advisor to help clients through it.
Yeah, and I think so many people have such like a recency bias. I know we've mentioned this on prior episodes, but everything feels so much worse than it's ever felt before. And although if you're near retirement, and let's just say you're 60 years old, you've been through these market downturns, time after time, as long as you've been invested in the market. So, it's not always as bad as it feels, although it feels worse than it usually is, just because, living in the present and kind of maybe your goals that you want to retire in a few years, as things are a little bit closer and you're starting to think about, do I have enough money to, kind of adhere to my goals or my lifestyle that I want to have moving forward, it always feels worse than it actually usually is. And to your point, remaining invested is usually the right thing to do. I mean, it's always the right thing to do. But the recency bias, it really shows in times like this, because if we could go back and name the last 5 times the market corrected, 10% or 15 or 20%, everybody who has these fears usually lets us know that, they have some type of nerves about the market and the way that things are heading. And then once things recover, it's kind of back to everything being normal again.
Well, then that's when everyone forgets that it happened.
Start to forget again. And then, like you said,
Yeah.
forget of every 4 years. So 3 or 4 years from now, it will happen again, and they'll forget how they felt during this time period. And it's our job as advisors to kind of navigate our clients through those turbulent times in the market and remind them of kind of what the market does and why remaining invested is so powerful.
And so we came up with kind of like 4 things or a list of things, doesn't have to be 4, of ways to just deal with this with clients. I think the first one starts with getting ahead of it. Have these conversations while the market's doing well, right? And especially for new clients, right? If someone comes to you in the beginning of 2021 or whatever, the fourth quarter of 2020, the market's just skyrocketing, it's going up quickly, that's the time to have the conversation that this also isn't normal. Like, this is, at some point, it will end. And when it ends, the market's going to retreat, and then it'll start over again, right? Preparing people in advance for that market, that environment. You can do that in a few different ways. You can make it part of your review meeting agenda, right? You could do proactive email campaigns to do that. You can involve social media with it as well. So that, for me, that was number one, is just saying, let's get ahead of it. And one of the things that I say in a new client meeting, especially, is, look, timing shouldn't define our relationship, right? You've met me today, and the market might very well be down 3 months from now, or it might be up. And it doesn't mean I'm a genius or an idiot, right? It's just because you met me, we started working together now. And having that conversation ahead of time, I think, is helpful to say, first of all, it tells people you don't have direct control over the markets. There's this outside factor, right? And the value of working together is going to be long-term, not immediate, right? It's not going to be based on market performance tomorrow. And so that, for me, number one is always just getting ahead of it.
Yeah, I think there's plenty of ways to get ahead of it, even with, like, this week especially, getting ahead of certain reports that are going to come out that you can already anticipate are going to cause some nerves for clients. Just sending out a reminder that, hey, we're paying attention to these certain events. We have your best interest in mind. We're watching your accounts, and just letting people know, I think, what they really value in an advisor, because most all folks understand the outside forces that we don't really have control of, obviously the market, but just letting them know we're paying attention to, their well-being, and we're here for them if they have any questions. But it's just making the clients feel like, their fees justified, and they have a working relationship with us. And it's not like we don't, they don't hear from us during market downturns, because I'm sure there's plenty of folks who probably don't hear from their advisor when things are going bad, and then probably only hear from when things are positive in the market. But we try to get out in front of GDP reports or inflation or Federal Reserve meetings, and they say, hey, we understand what's going on. It's out of our control, but we still have your goals in mind.
Right. And that's a good important point too. I think there's also, look, as an advisor, it feels bad when the market goes down. Look, we're human too, and so there's an emotional response for us as well. We don't want people to lose money, right? We'd never want that to happen. If it were up to us, the market would always go up, until you understand what the market actually is, and then you actually, not that you root for it. I don't root for down markets, but I welcome them more fully now, because I know the impact that has long term. That volatility is the ticket to the show, right? It gives you outsized returns over time versus just leaving it in a bank account. But I think one of the points that you were, I think, touched on was, be proactive with the folks that need it, right? we look, again, it's scary for us. We don't want to, it's as a human being, you don't want to have tough conversations with people, but that's what we're compensated to do. Right. And so, yeah, getting those emails out are important, but for those folks that, are a little bit more reactionary to environments like this, to reach out proactively and have the conversation. It's much better if they receive a call from you than you to receive a call from them, right? Just now you might have the exact same conversation as a result of it, but the appreciation, I think, of your advisor reaching out goes a really long way.
Yeah, it also seems kind of funny to say that these types of market environments or market corrections or recessions, for the long-term health of the market, they're actually healthy in a way to go through these periods of market volatility or corrections. But if you look at, and we've put this up on previous episodes, but a chart of the last 20, 30 years, although there's volatility along the way, if you drew a straight line all the way across, it's straight up to the right. So one of the analogies that I kind of thought of was we need these different market environments to occur for the long-term health of the market to continue. And I kind of thought of like Sequoia trees, where, everybody thinks they see these forest fires and it's obviously devastating to a lot of different communities and obviously for wildlife. But certain parts of the forest, like Sequoia trees, they actually need fire. They need to be burned and able to reproduce. So I just thought that was kind of like the last 6 months have been pretty turbulent in the market, but forward looking, it's probably a good thing that we went through this type of market environment just to move forward, as the market always does.
Yeah, I like that analogy. I think the point you made when we were talking about it earlier was eventually there's a forest, right? So it creates this growth, and now it's compounding growth, right? So you have more than one tree now in the next fire, dropping seeds and whatever, and growing more and more and more and more. So there's this compounding thing going on. It's the same thing that happens. It's unbelievable how nature imitates finance in a lot of different ways, or how life imitates finance. We're all human beings doing all this stuff together, and even though we live in houses and wear clothes and stuff, we're still part of nature, right? So we're all made of the same stuff. What I think Neil deGrasse Tyson says, we're all made of stardust or whatever it is. And so we have similar. It's not surprising that the market takes a dump, goes down for a little while, then recovers, and goes down for a little while, then recovers. But ultimately, it's compounding and growing the forest, right? So it's a really cool analogy. I'm glad you brought that up. Actually, it leads to our other conversation, which is around personal finance. And it's such a simple concept, and it's but market environments like this get in the way, right? And that is, look, to grow wealth, all you have to do is two things, and only one is really contingent upon you. One is save. That's the thing you have to control, right? How much you save and when you save. And then wait. That's it. And just wait. Save and invest it. I should add invest, right? Put it in a diversified ETF, and then wait. And that's it. And so it's really as simple as that. If you can take away the emotional roller coaster ride you're going to go on through it all. But to young folks that are starting out, or those that are just starting savings, just start saving and wait, right? You're going to be rewarded for waiting. And I use Warren Buffett as one of my examples. He's like, one of the wealthiest people in the world, but he's also, kind of propped up as one of the best investors in the world. And so what was interesting to me, you look at his net worth from, I think they started at age 14. I don't know who took his census at age 14, and he said he had $5,000. But anyway, I guess maybe one of the interviews he said he had $5,000 at age 14. So that's where it started. And then up to age, 66, he amassed a fortune of $17 billion. It's crazy. It's unbelievable, right? Fantastic investor. You know, Berkshire. I mean, he's amazing, right? But where would 17 billion be on the list of top investors today, or top net worth lists today? Nowhere. They'd be nowhere. What's interesting to me is that 80% of his net worth came post age 66. So he's 91 now, I think. So the last 25 years, he amassed 80%. It's now around $93 million. So 80% of his net worth came in the last 25 years after his 66th birthday. So what would he tell you? And he said it before in interviews. What's the defining factor for how you've amassed all this wealth? Well, part of it's time. A big part of it's time, right? The longer you wait and let this thing compound over and over again, let those trees grow, the more wealth you'll amass.
Yeah, I think one thing he always preaches is patience. And if I remember correctly, he says that the market is a tool or a transfer of wealth from the impatient to the patient. So that just goes to show that those who are reactionary versus those who are not reactionary and are patient, he says the market is a transfer of wealth from the impatient to the patient over time. And he's a perfect example, although he's an extreme example. We're not all going to become billionaires for just saving into our 401ks or other retirement plans and investing in index funds. But it does go to show that even the average investor or somebody who doesn't know a lot about investing, if they contribute every single pay period and they go into funds that align with their retirement timeline and retirement goals, they should be pretty well off, given the fact if they just are patient along the way and kind of have a forward-looking mentality that 20 years from now, 30 years from now, this money is going to be able to sustain my retirement goals.
Yeah, and there's an example that we'll put up on the screen here. But if you saved $500 a month and you never increased that, it was $500 a month from age 25, and the average annual growth is around 6%, right, on those dollars. So it's a 60-40 portfolio or something like that. By age 66, you'd have like $1.1 million, right? So that money that you're saving it's such a small amount in the beginning, so it doesn't feel like you're making progress. But give it time. When you give it time, you'll see that things start to expand quickly. And actually, we did the math, if you stopped saving at 66 and just let that ride like Warren Buffett did through age 91, that 1.1 million would quadruple. It'd become 4.5 or $4.6 million with the same 6%. So time, once you begin to amass that wealth and not make foolish decisions around it, is the most important factor. But you have to start. And starting small is fine. $25, $50, whatever it is. But and then you can, as you get a pay raise, you can increase your savings, right? So you don't have to be saving $500 a month or $1,000 a month to start. These days, with ETFs, there are no minimums. So I think it's just a good example of just there isn't a lot of work that has to go into investing. It's just getting started and then being patient.
Isn't that the hardest part with most things, is just getting started?
Yeah.
So once you get started, it's pretty easy.
Yeah. It's like working out, really. If you think about it, it's like to get started, it's tough. You're not going to see a lot of progress. And then all of a sudden, you kind of like, oh my gosh, I'm in good shape, and I can run faster or jump higher or lift more weight or whatever it is, whatever's your goal is. But in the first few months, you don't see a lot. You don't see a lot of, and then it accelerates after that. It's a lot, like a lot of things.
Well, we don't have pop chart today, but
we
do want to bring in one more topic, which is the the buzzword over the last, 2-3 years at this point, which is NFTs. Touch on that real quick. So I will say, I actually just received my first NFT.
All right.
It was a gift. So it was my birthday last week, and it was a gift from a friend who actually creates his own NFT called Fiat Bear. And
is there any way we can put that up on the screen? Your Fiat Bear?
We'll pull it up. We'll pull Fiat Bear on the screen. We'll actually show you the one that I received.
As long as nobody copies and pastes it, right? That's the only downside to this, right? I'm just kidding.
But it's on the Solana blockchain, and it's pretty neat. Just getting into to see that I'm now an owner of an NFT and kind of going into that world. But it's interesting as like my friend who creates this, just kind of hear about how it works and how he got into it. He's kind of got an artistic background, so it's pretty easy for him to start creating these. But we'll see where it goes from here. So I'll update in future episodes as his Fiat Bear inventory expands, or maybe he starts to do different things with them. But we will pull it up on the screen to show our viewers my first NFT that I received the other week.
Yeah.
And I also was reading a article about Nike getting into branded NFTs inside of video games. So the big thing has been that NFTs have had a huge downfall in the past 6 months to a year. And
like every other crypto,
a lot of companies
assets,
every other crypto asset. But it's interesting because a lot of large companies still see this as an area of opportunity. As other people, I think both of us see it as something for the future. But what they're trying to do is in-game NFTs. So let's just say in NBA 2K, you can purchase the Nike branded shoes as an NFT, but we're trying to still figure out, and it's not known yet what somebody would purchase that for. Is it just to have it as a collectible in game, just to show it off, say, hey, I bought these Nike branded shoes within my video game, or can I have some utility to it where it kind of changes the gameplay, or it increases the abilities of that specific player or character or whoever you're using? So it's interesting just to hear that they are entering this space, but we'll see where it goes from here.
I think at some point, every ticket you buy, or I don't know, let's say Nike decides it's outside of a game, right? They decided to say, okay, we're going to sell tickets for a new sneaker release, right? Sneakers are just they're huge right now. Are you into that stuff?
A little bit, not as much as a lot of other folks, but a little bit.
I don't even know. I've seen some videos of it, but it's just way above my head.
What's the exchange called where they have other things besides sneakers, I'm pretty sure.
StockX.
It's like a StockX,
Yeah.
It's like a market for things like shoes.
I bought a pair of shoes before, like a new release, Adidas.
Oh, really?
What are they called? They were like all white 4D parlays or something like that, and I won the thing. So I spent like $200 to get these shoes. No, $250 to buy these shoes.
What is it, like eBay in essence? Like how you?
No, I
bid
bought
on
it. It was from Adidas. So I won the raffle, got it, and at one point on StockX they were trading for like $400 in my size.
Oh, wow.
I didn't sell them then though. So now they're back down to I think $250 or something like that. So, but these kids make there's like sneakers that are worth like $100,000. Like some crazy numbers like that. Yeah. Anyway, where we're going with it is saying, what if Nike or Adidas, whoever, decides to do like a raffle or whatever, and what you're buying? Adidas, by the way, does have NFTs as well. You buy your ticket is an NFT, right? And maybe that comes with privileges next time. So you own this little thing that comes with additional privileges the next drawing. I think that's gonna be the way, like a Phillies ticket or any sporting event ticket. Maybe it gives you the option for something down the line. It doesn't have to be tomorrow. It could be 2 years from now. But you own this little NFT that, I don't know. I think it's a way for companies to market that consumer beyond that one-time transaction, right? Because you would say, oh, something I just got pinged on my NFT that I bought from the Phillies game a year ago, and it brings the whole idea of, oh, I can buy this hat now. They're giving me an option to buy this hat ahead of everybody else. So it keeps a way to keep the consumer engaged in that particular product, whatever it is, sporting event or shoes or whatever.
Couldn't that be for like Eagles or like one I like to use is like the Sixers, right? So let's just say it's like season ticket holders or like 10 game or partial season ticket holders or like 10 game package holders, where the NFT would give you the right or the ability to go buy like first dibs on like playoff tickets or whatever it is, like early access to first, second, third, whatever round of the playoffs. But that NFT would come with, because they say that already, but that's essentially what an NFT could do. Like they give you priority access to those tickets as a regular ticket holder, but the NFT, if you just bought the NFT, it would just give you first offering to those tickets, essentially. Something like
absolutely. But it also could be a way of them marketing to you in the future without having to go out and look at a website or follow a Twitter account or anything like that. You just,
absolutely.
And maybe it has some residual value, a couple bucks or whatever. So you're not going to just forget about it. Right. I really think that's going to be the way that it's just an inexpensive way for companies to keep the consumer on the hook. And that's what they're looking for all the time, So I believe in the future, like all these events are going to be NFTs. These days you don't even have paper tickets anymore. It's all on your phone. So it's the natural progression towards that. But we have to get your buddy on, talk about the process. I'd be interested to hear what that's like and what the actual process of getting the NFTs, on the Solana network, and then how he, sells it or transacts. Anyway.
Yeah, we'll get him on to discuss it at some point.
I mean, he's going to be able to market this to our millions of followers, so that's naturally it's going to be a good fit,
Yeah, might take a few years to get to that point.